Everybody hears the success stories of how someone did this and someone did that on non-farm payroll. I made this much money. I made that much money. I'm able to get a withdrawal for this much money because I killed it on non-farm payroll. And you're learning that there is a lot more to it than just getting lucky, surviving that carnival ride. And while most retail traders, people that use logic that has no bearing on why price is going to go up or down, they will subscribe to the view that, hey, their techniques, their models, even my concepts in the hands of other people, they may sell the idea that, hey, look, I got it all figured out. And as I mentioned, every single time I've ever talked about non-farm payroll, I said the same thing Friday. I said, you don't know. No one knows where it's going to go. And inviting ruin, inviting the potential for the market to just start spooling and running way beyond where you think it's going to go. Ignoring that underlying risk, ignoring it, discounting it, thinking it's not going to happen to you. Not this time. You're romancing the uncertainty. You're only looking at it from the perspective that it's going to be good for you. It's going to be good. It's a good thing for me to do this. That's what you tell yourself. That's what you're thinking. In reality, you're most likely anxious. That's why you never said anything in front of the public about what you were doing. But when it works, you're going to come out and show your market replay execution. Look at this. Look what I did. I killed it. If you were that confident, you would have done it live. You would have done it in advance. And the fact that you won't do that, or that you see other people doing it just like that, it's cause for concern. You're spending too much time doing the wrong things, worrying about the wrong things, and romancing the uncertainty, only seeing it through rose-colored glasses as an expression that you can only see it your way, or the good side only, and not realizing the underlying risks that are associated with it. But buying and selling, executing on a short-term basis, just trading the intraday volatility, using any immediate lower time frame, 15-second or 1 minute fair value gap, and conditioning yourself to just see it and execute on it. See it and execute on it. Place a stop and a limit, and submit to both. Whichever one happens to be hit first, that's what you're going to subscribe to for that exercise. And you desensitize yourself. See, that is the right thing to do. Not going in thinking it's always going to be an outcome that's favorable to me. You need to remove that thought process entirely. You need to remove the necessity for the outcome to be positive for you. Because if you focus on that in the beginning, while you're discovering who you are, what you're going to do to wreck yourself, before you discover your character flaws, every one of us have them, you won't grow efficiently in your understanding. You won't have an understanding of what you're trying to become. Because in the beginning, you really don't know what you're trying to do. You don't know what your ending model is going to be. You don't know how you're going to perform as a career trader. You're not going to understand the things that you don't know yet, because you don't know what you don't know. And that uncertainty for you isn't being romanced. It's being explored. It's being navigated. Much like Christopher Columbus, who set out and discovered America and whatnot. Imagine how scary that would have been for him. Do you think he was trying to talk himself out of it all the time? Or was he thinking, how amazing is it going to be once I discover something new? And he submitted through the process of discovering it, getting out there in the uncharted waters. The hard right edge of every single chart, every single one of them, that hard right edge, that's the retail drowning pool. You see so many traders now. Go on social media. Look. There's stories of regret and woe. I blew my accounts. I lost my funded account. I failed the combine. I don't know what happened on Friday. Why was the market so hard on Friday? Why was the market so choppy this week? The market was trash this week. That's the retail drowning pool, that hard right edge. They want to believe in their fairy tales and myths about why price does this and does that and what indicator causes it to go up and down. But none of them spend the time, like I've been teaching you, to focus on when it's going to be less likely for you to succeed. You're not romancing the uncertainty. You're removing any emotion about that hard right edge. You're looking at, why would price go up? Why would price go down? Who is it going to hurt? Because that's what this game's about. It's about taking. It's about overtaking and devouring. That's what it's all about. It's nothing else but that. And your indicators are going to crunch numbers and spit out some data that you're going to subscribe a religion to. If you're a retail-minded thinker, you're placing faith, almost a degree and level of religion, over these indicators. Like they're somehow going to cause price to bend to their will. Stochastic says you got to go up. RSI diverge. That means you can't go any lower. You cannot go any lower. You might as well just start going up right now. I used to talk like that to my charts. As a 20-year-old, I said, there's no way they can keep going down. It's diverged twice. It's been oversold for hours. It has to go up now. Everybody sees the same thing, so they got to be doing what? Buying it up. And everybody buying it up should cause it to go higher. Yep, that was me being religious about price action. And that was also me losing money. That hard right edge is no longer scary to you, because you understand where you're at in price relative to the dealing range, the seasonality, what month of the year you're in, what week of that month you're in, what day of the week you're on, what the economic climate is for that week because of the economic calendar. And you're learning how to navigate uncharted waters. You don't know if there's any rocks just beneath the surface that might strike the bottom of your vessel and cause you to sink, but you're not obsessively worrying about that either. You're exploring the uncharted territory of your future self. And while that is exciting, you have to tame that overzealous nature, that, like a child waiting on Christmas morning, they can't wait to get up and see what St. Nicholas left them under their tree. What presents are the market makers going to lay in your hands today is a profitable trade? The market maker doesn't let you sit on his lap and ask for what you want for Christmas. It's designed to consume you. So when you adopt the mindset that cannibalizes retail thought, then you are out of its reach. You're just outside of the influence and the religious perspective held over price that indicators and retail logic presents. It takes more faith for people to believe in those things than it is to simply study price action naked and study it through the lens of time and price, inefficiencies, liquidity, seasonality, all those things that are factual influences. These are things that really have an influence and effect over price, and they can be scheduled as a time when you're going to engage the marketplace, because there's an economic calendar that you can look at and say, hey, there's going to be a lot of volatility this day. This specific day of the week, there's going to be lots of volatility that day. And if it happens to be on the latter half of the week, well, you understand now that the cleanest price action is going to be where? At the front of the week. And the retail crowd, the casino goers, the gamblers, the less informed street money is going to be out there on Thursday and Friday pressing really hard to try to do something amazing when the market's more likely to do nothing in their favor but hurt them. Take a look at your chart on a 15-minute time frame. Look at the NASDAQ. Wednesday's trading, Thursday's trading, and Friday's trading. Contrast that with Monday and Tuesday's trading. Whole lot different in terms of how price was delivered. Do you want to be in a market that has difficulty? The difficulty in producing low resistance liquidity runs, where the market just runs quickly, expediently, right to your targets with very little, if at all, retracements. Hardly any consolidations, barely any pause whatsoever. It just runs quickly and goes right to your target. Or do you want to be in a market that has to be babysat? And you're constantly concerned about, is this retracement going to be one that stops me out and then eventually goes in my favor later on? That's trading in high resistance liquidity runs. See, there's a benefit in understanding the lay of the land. Knowing how that economic calendar is going to impact future price, days that haven't even started yet. You're looking at these things on the weekend, anticipating how the week is going to be problematic on certain times and days. But retail's not thinking that way. They go in and they're hoping that their harmonic patterns are lining up. They hope that they're seeing their indicators become oversold or overbought. They're waiting with bated breath that their moving averages are sloping in the direction they want to be buying or selling in. Where you are different. You're calm, you're calculated, you're patient, because you know that given day, there should be some kind of opening imbalance, some kind of difference that's significant from the previous day's settlement price to 9:30's opening price. And to the degree of how much of an imbalance is created by that, you get intel, you get information that tells you more about how that daily candlestick is going to deliver. And you understand that if there is a opening price higher at 9:30 a.m. New York local time than that of the closing price at 4:14 p.m. Eastern Standard Time, previous day. If it gaps open higher, and it's a significant gap, you know that there is, in the first 30 minutes, statistical probability that's 70% over the last 40 years, that in the first 30 minutes, that your short-term bias should be bearish in that instance, trading down to half of whatever that gap is. Retail doesn't think that way. They don't go in anticipating something like that. Retail sees this. Well, we gapped open higher, so that means it's strong. Let's buy it. If you measure the relationship between where we closed the previous day, and this is something for you guys that like to make indicators in PineScript for TradingView, here's a challenge for you. Ready? Create an indicator that plots a cumulative line. Okay? And you want to plot it with measuring the rate of change between previous day's close to today's opening price. And you can start with a number like, I don't know, use a value like 10,000 or 100,000. And then today's opening price, how many ticks is it above previous settlement? How many handles is it or points above it? And you would add that many to that original starting value. And then every day plus or minus, you're adding or subtracting to that, and it's creating this cumulative line. Eventually, what you'll start seeing is that's measuring the public's perspective, because they see, oh, we opened up higher than the previous day's close. That's bullish. And they will want to do what? It's higher. It's strong. Let's buy it. Buy, 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 buy. And that's why I told you on Friday, I'm not interested in being long. To the jokers that like to say I was looking for longs. I was not looking for longs. I was absolutely not looking for longs. I was looking for further protraction because it's non-farm payroll. It can deliver that and screw you over. Everybody now knows that if there's an opening gap higher, that's a premium gap. Inside that first 30 minutes, your bias is bearish. Always. You're never chasing that. You're never buying that. Never, ever, ever looking for longs like that, ever. That's somebody that doesn't listen. That's someone taking things out of context. That's someone that's a joker online. Don't take that as a compliment, because I'm not talking like a Heath Ledger joker. I'm talking about a grade A clown, a circus fucking animal, okay? So when you measure the perspective by looking at where we opened today at 9:30 related to how we closed, the public's perspective is it's strong, it's going higher. Where the professional perspective is, what do we do from the opening price and how do we close that day? That's very telling, because what you can actually start doing is you can get a diametrically opposed measurement with a simple cumulative line. And by doing it on the open to close relationship, you end up with Larry Williams' accumulation distribution formula. But if you switch the logic and you do a cumulative line basis on the difference between previous close to opening of today, you're measuring the public's perspective. What do you think happens? Think now. What do you think happens when you plot both of those lines as an overlay, one over top the other? And one fails to make higher highs when the other one does. And what happens when the public's perspective, which is the opening price related to previous day's close, is showing higher highs? When the measurement between the opening price to the closing price is saying, I'm not going up there like that. What do you think happens? That divergence is showing you an arm wrestling match between street money, stupid people, uninformed money, and the professionals in the marketplace. See, retail traders are not going in, okay? Now, when I say retail traders, I'm not saying like the people like the YouTube streamers and whatnot, that everybody understands that there's a gap, and gaps tend to trade back into them, but not all the time. That's how I can tell you where there's a breakaway gap. They're not going to be able to tell you which one's going to be a breakaway gap. I have that logic. I can tell you which one's going to be a measuring gap. I can tell you which one's going to be an exhaustion gap. I can tell you where the fair value gaps are going to form before they form in your chart. That's logic that's not found in your books. But let's clarify something. When I say retail collectively are looking at that higher opening price at 9:30 relative to previous day's settlement price at 4:14, always New York local time. When they see that opening price higher, in their minds, immediately they're bullish. They're looking for some kind of continuation higher. Collectively. Now, inside of the retail classification of traders, there are individuals that know how to fade that opening gap. Some of them look for a full gap closure because that's what they think is going to happen. But not all gaps completely fill in. I'm teaching you that when you're bullish, you don't really want to see a full gap closure. And you don't find that in your books. You find them in all the people that study from me now on Amazon. That's a given now. But prior to 2016, when people were taking my leaked content and turning them into books and study guides and whatnot, nobody thought about just leaving a portion of the gap open and seeing that as bullish when it's gapped higher and trades down to half gap or 3/4 gap closure. Leaving something open it indicates underlying strength, or in deference to when the market opens lower with a gap lower opening at 9:30, the public perceives that as extreme weakness, and it means it's going to go lower. So their sentiment is immediately established as, let's get short. But the professional mindset, now let's be honest, okay? You're trading as a retail trader, but I'm training you to think unlike a retail trader. You have to trade as a retail trader in a retail brokerage account, but you're not thinking like every retail trader is. So you're thinking like smart money. You are a retail trader, but you're not thinking like a retail trader. You're not falling victim to the nonsense that these individuals subscribe to as the reasons for why price goes up and down. You're not doing that. You're not making those foolish assumptions over price. That because it looks like some kind of animal pattern, some kind of geographic pattern connecting the dots and trend lines, and therefore it makes some kind of a illustration, like a horoscope. You're looking at the real factors why price goes up and down. And if you can measure and compare the relationships on how, on a cumulative line basis, it's a very simple process. If the gap's higher at the open, however many handles or ticks it goes up and opens up from the previous settlement price, that's how much your indicator value adds to the cumulative line. And then you do the same thing by plotting the difference between the opening price to the closing price. And if you do that, what you'll start seeing is an X-ray view of real accumulation and distribution against the weak-handed public traders. And that's why when we look at these large opening gaps and the market has been building up, like I was describing on Friday in live stream, I said I would never chase this buying it. I would never go long. I'm not interested in buying it. I don't care if it went up to the primary buy side. I'm not buying that because we already established a huge gap. And that's going to do what? It's going to entice retail traders to look for longs. I'm not looking for longs. I'm looking for the final Judas swing. And when we finally broke down, we started consolidating and created that little tiny little messy little range. I said, I'm going to cut through all this chaff right here and I'm going to focus on this little fair value gap in here. Well, where was the gap? It was gap higher. So the bias is what? Bearish. It displaced lower. And I pointed right to that little fair value gap. I said, now that one, if all things being equal, and if this is weak, if it's bearish, it's going to stay in the lower half of that fair value gap and not trade in the upper half. And you watch that happen. And it trade down to mid gap and sell side. That's the professional perspective. Waiting for the indications that it's finally broke, it's shifted lower, wait for a premium array. And then when it performs, expect the upper half of it not to be traded to. And then the professional mindset is we opened higher, that's a premium. Professionals sell short in premium. They don't buy.